In this video, I'm going to talk about International Consolidated Airlines, or IAG, by giving my views on the business and whether you should buy IAG stock right now. Disclaimer, I'm not a financial advisor, and if you seek financial advice, please see a licensed professional. Don't forget to leave your suggestions in the comment section down below. Currently, I'm only covering FTSE 100 listed stocks. As usual, all of my research for these stock analysis are in the bottom of the description down below, so don't forget to check the sources if you don't believe some of my information presented, and drop me one of these to support the series. Thank you. International Consolidated Airlines Group provides passenger and cargo transportation services mainly in the UK, Spain and Ireland, but also the rest of the world. This company owns British Airways, as you already likely know. They also own some other brands, which I'm going to butcher the pronunciation of, such as Iberia, Vueling, Aer Lingus and the Level airline brand. They had operated a fleet of 579 different aircraft, and they were flying to 279 different destinations. However, with the ongoing pandemic and travel restrictions, this is subject to change. Firstly, this is a stock that has been heavily impacted by the pandemic and subsequently lockdowns, and so valuation metrics aren't going to give this stock a lot of justice. It's going to make it very difficult to really find the intrinsic value of IAG. Regardless, IAG has a negative price to earnings ratio of minus 0.7 times. This suggests that the company is currently unprofitable, which is no real surprise considering the travel restrictions and the limited amount of people currently traveling. But it does present an opportunity for the future, as this could be a very cheap valuation, and in which in 10-15 years down the line, they may no longer be unprofitable and they may be doing extremely well. As currently investor sentiment is very low, if they are able to reverse the negative earnings trend, then this could be an excellent opportunity. However, when comparing their market capitalization to their net assets, or using their price to book ratio, we can see that they are deemed as overvalued. They currently have a ratio of 2.5 times, which is higher than the industry and the market. Although I suspect this is due to their current loss making, and because they are loss making, they're obviously losing some of their assets, such as their cash position, and therefore their ratio is going up because they are losing asset value. What I am interested in, however, is the skill of IAG's management and how well they're able to deal with this uncertain situation. To identify how strong the management is, we need to look at their returns, and I like to look at things like returns on equity and returns on capital employed. I also like to see how well the business has grown in the last few years. Although at the moment they're going to have negative return on equity figures simply because they are loss making. So what I'm going to do is look at last year's report on what their return on equity is, so that once this company has recovered, we could expect a general figure of this, which in fact last year was actually 25.49% return on equity, which I think is an excellent figure to have, which is compared to the industry of 8.2%, suggesting that when they are in operation, that they are better than their industry, and that prior to the pandemic, the IAG could have been a great growth potential stock. I think this is actually very much backed up by their returns on capital employed, or how much profits they can make from their investments. Whilst it is currently on a trailing 12-month period only 1.6%, if we look about how much it was 3 years ago, then we'll see it was actually 17.5%. I personally believe a return on capital employed of above 20% is very, very good. Therefore, I personally feel that a 17.5% is a good position to be in, especially for an airline. Furthermore, what really is impressive is how well they had managed to grow their earnings prior to this loss. And whilst you may see in the last 5 years, on average, earnings decline of minus 8.9%, in the last year, they had a negative earnings growth of 225.9%, suggesting to me, whilst yes, IAG are currently struggling, it is a lot better than it could have been. And in fact, they could have been in a much worse position, which suggests how strong of a business they were prior to the pandemic. But back to reality, for the first 3 months of the year, they did report a £1.5 billion loss, and subsequently for the whole half of the first year, they had reported a £3.8 billion loss, suggesting to me that they're actually increasing in the speed in which their earnings are declining, and so this doesn't look great for their future. So how is the quality of their balance sheet, and are they able to survive this even if their earnings continue to freefall? Well, IAG has a fairly poor balance sheet. Their short-term assets do not outweigh their short-term liabilities, and they do not outweigh their long-term liabilities. This is combined with an astronomically high debt-to-equity ratio, which, from looking at various different sources, are different in each place I look. When using simply Wall Street, they suggest they're on a debt-to-equity ratio of 750.1%. Although when I look at uk.investing.com, they suggest it has a 2,115%. So do take these results with a grain of salt, but it is important to realise that this is a lot of debt and subsequently a lot of risk for investors, as this debt can certainly stack up and very much lead to bankruptcy. And please consider subscribing, as it doesn't cost a penny and it is free. Thank you. However, the one redeeming trait is that they do have a strong cash position of 5.9 billion euros. And since their cash flow is negative, it does mean they will be unable to cover their debt should it continue increasing. However, I do believe this cash could cover their debt if they would choose to do that, although I'm pretty sure they would like to conserve this cash and delay their debt payments so that they can survive as a business. Furthermore, they've had to dilute their shares pool, and this is done by releasing a share right offering, basically increasing the number of shares available in the share pool. And what they've done is diluted the whole pool by 145%, effectively meaning that they will lose a significant chunk of their value, simply because there's more shares now in the share pool, therefore the value of each individual share is less. On the flip side for the business, this is quite good as it raises them an additional 2.4 billion euros, and it certainly could increase their chances of survivability in the future. For those of you interested in the dividend potential of IAG, it is forecasted to have a dividend yield of 5.9%. This is taking into account that they did initially cut their dividend before suspended it, and so it's assuming that if they do resume their dividend, that it will resume it to the cut levels and not the levels prior to that. Otherwise the yield would be so much higher. Typically, IAG had a payout ratio on average in the last 5 years of around about 26%. Regardless, this was a biannual payer, paying in July and December each year. Do also note that they did pay a dividend in euro cents, meaning if you have a stockbroker that charges for currency conversion, then you're very likely to lose out money to fees. IAG do have a limited dividend history of 5 years. However, on 4 of those years, they did manage to grow it, and these were ranging between 14 to 18% each year, which really isn't bad. And it suggests to me that this is a company that when the economic cycles are booming, that this company will do well and be able to increase their dividend and other things. However, in a term of economic uncertainty and turmoil, that this is a company that may potentially struggle more than others. I suspect this would have been a nice income stock because it had higher than market average dividend growth rates, and it was a higher than average yield. However, I cannot seriously see IAG paying a dividend until at least 2023. They have a lot of debt to pay off and businesses to recover beforehand. Before giving my conclusion on this stock, there are some serious risks that I'd like to talk about, and if you're considering buying IAG, you should really listen to them. The first risk is that if the pandemic continues to spread, that there will be further travel restrictions, meaning that IAG will therefore have less destinations that it can provide flights to, therefore meaning that they will not make as much money. This is because they'll have not only less travel destinations, but also the customers may potentially fear the idea of traveling. You may well know that a lot of insurance firms have rejected paying travel insurance simply to cover their own capital. And therefore, if you're risking yourself by going to another country and not getting travel insurance, then there's a significant price to pay if you fall ill, and therefore you could be paying some seriously high amounts to get yourself back in good health. Secondly, this can compound and become a lot worse. This is because if there is a fear of flying abroad, then there'll be a lack of demand for flights. That means that IAG would likely have to drop the prices of their flights in order to convince people to travel, therefore meaning that this will be eating into their profit margins. Furthermore, this could impact their ability to repay their debt, and therefore that debt could increase, leading to bankruptcy. Even as fears ease and flights resume, they likely will have to take into place some social distancing measures, meaning they will not be as profitable as they were simply because there will be less customers on a plane and therefore less money per flight. I strongly believe this to be a great opportunity for investors that want a speculative recovery play. This is because firstly, I do not believe a company as big as IAG will go bankrupt. However, do not misunderstand me. That does not mean that you can't lose money on this share. I mean that the governments will likely bail out this company, but if you are holding shares of the company, they don't necessarily have to care about your stake and could leave that to rot. So don't rely on that. I think this is an excellent opportunity for someone looking for a long-term hold that they could get excellent value out of whilst it is being heavily beaten up. And if you feel that airlines will recover, traveling will resume to peak levels in the medium term, then it could be for you. If you'd have held this stock in the last 5 years, you would have gotten returns of negative 70.8% with dividends reinvested, compared to the market of 16%. I'm personally not going to invest in this stock simply because I'm not a fan of the travel sector and I look for other businesses with better growth potential. However, I will be keeping an eye on their earnings report in October 20th, as this will give me a good general insight onto how the airline industry is doing. As usual, I would strongly suggest against putting a lump sum of money into this stock simply because it's at such a cheap price that it can't go any lower. Well, it will. I would personally drip feed a small amount of money consistently into the market and be careful not to let this position become too overweight in your portfolio. Let it sit at around about 1 to 2%, maybe 5% if you're feeling very risky, but any further than that, I think you're very likely to risk your entire portfolio. If you take one thing from this video, make sure you have the confidence and conviction to hold this stock for at least 5 years, as in the next 5 years, this stock could drop another 50% and flights might not be at their peak levels. You will need to be able to do your own research, understand this stock, and know how long to hold for. And if you are looking for a long-term stock, you've done your research, you're confident in the industry, then I do believe this is a good stock opportunity for you. If you're interested in my HSBC/HSBA stock analysis, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great weekend.